Hi guys, and this is the lesson 5, and this is the lesson 5 of the part 2. Today we're gonna talk about Fibonacci retracement. Okay, we're gonna talk about Fibonacci retracement. There is Fibonacci retracement, and there is Fibonacci extension. Now, I did think about doing extension at the same time, but I think I'm gonna leave Fibonacci extension for the strategy, so we can use it to set of targets. I did think about put it right now, but the second part of the class is more about presenting you guys the bulk of the tools that we use, and part 3 is more about actually using them. So let's go ahead and start right away. And quick disclaimer: this channel does not intend to replace any training and coaching programs. It is a deep introduction of the world of crypto trading, and technical analysis. The series of this channel must not be considered as financial advices. Our contents are only here to educate, inform, and entertain. Trading can be very risky. Only risk money you can afford to lose. And book in a few weeks, and this I promise it. Fibonacci is what is Fibonacci sequences? Now, it was named after Italian mathematician Fibonacci. It's a sequence of numbers in which each successive numbers in the sequence is obtained by adding the two previous numbers of the sequence. It is present in everything in nature. I strongly recommend that you Google Fibonacci. This is a very fun thing to read about as a general knowledge, I'll say, not just for trading. So there's no need to give too much detail here. Like I say, do your own research. It's fun to read about Fibonacci. It's fun to see how much Fibonacci sequences is involved in almost everything in nature, and this is why Fibonacci is unbelievably powerful in the market. Now, the Fibonacci sequences help analyze the deepness of a retracement or the height of a bear rally. If you don't know the difference between retracement and bear rally by now, I'm not gonna go over this again. There's just way too much information about this on this channel. In a bull market, is useful to buy retracement. This is how you get the best entry point. And in the bear market, the inverse is the case. This is where you look for to short bear rallies. Now, Fibonacci retracement is a biased name for the subject, as it suggests that we are bullish, but the same principle is also applied when we're going down, but we should have changed the name into Fibonacci bear rallies, I don't know, something like that, but we'll just leave the name like that. There's no need to become so scientists changing name kind of stuff right there. So Fibonacci level, if you're using TradingView, I don't have to go ahead and show you, because on my analysis you probably see me doing this in real life in the channel, and in the Discord channel you'll see me doing it live. So there's no need to show you where it is. People ask me, where's my Fibonacci tools? You're just gonna do it and look for it. It's a different place in different exchange and charting system. Now, the most important thing about Fibonacci is this: you have a set of sequences, and you have the 23. You're gonna hear about 23, 60%, 38%, 50, 61%. I want you to pay attention to the most important thing for me usually is those three sequences and this one. I put them separately because often on my trades I use them interchangeably, for different strategy. So I can use a ladder entry. If you don't know what that is, you need to go back and go over some videos. When you use a ladder entry at this level, and a stop loss here. Another possibility is that we ladder those full level. So I put these two here, but usually this is called the golden pocket. The 61% is called the golden pocket. You will hear traders saying that, I'm gonna buy the golden pocket, buy or sell the golden pocket. I can ladder those full level. That's 1, 2, 3, 4 level, and my stop loss would be somewhere here. Now let me tell you the reason why you need to place your stop loss at least at the 100%. In a previous video I told you, if a wave retraces 100% on itself, this wave is the first sign of reversal of any trend. Same thing if you have a bear rally that returns 100% on itself, this is the first sign of the reversal of any trend. Just this, you get out, you stay out, and look for we are reversing. This is where you look for reversal. So Fibonacci level in the market, they behave like statics. Those level, they literally behave like support and resistances. They behave like support and resistances. There is a strategy that we're going to talk about in which we ladder and we stay inside of the Fibonacci sequences. The entry is there and the exit is also there. I'm not gonna go ahead and place it there. Like I said, the second part is not about strategy. Inside of this, it's a trading strategy that honestly is one of the most profitable I know on a day trading style, in which you use those level to enter and exit inside of the Fibonacci sequences. There's a way to ladder, particularly using the strategy. It's a mathematical set of things. You balance it with your portfolio. Your stop loss is there. You use this. Those levels. Some of those levels are used as entry point, and some of them are used at exit point. Very interesting strategy. We're gonna have to talk about it in third part of the class. Applicable wave 1, 3 Elliott wave, but the entire structure, since the entire structure, when we have 5 waves equal 1 impulse, so you have to make the Fibonacci of the entire thing. For an example, we just talk about that. This is simple Elliott wave scenario in which this entire thing is an impulse and a correction. So you're gonna use your Fibonacci tool in the first wave, and let's say that we retrace, okay, and all the way down to 50%. Sometimes we retrace a little bit deeper, and then you use Fibonacci to enter this particular thing right there. Now this is where it's interesting. Let me show you something. Let's say that we were doing down before that. You have like 1, 2, 3, 4, 5. I know this one is terrible, but as you get the point. And then you had a confirmed downtrend line somewhere here, and this thing create an inverted head and shoulder. Now you see this, you be like, well, maybe this is a first wave. Usually first wave, they retrace very deep. We are talking about 38, 50, 61, and sometimes even there. If it's not a first wave, it will retrace 100% on itself. So you can go ahead and place your buy order here, buy order here, buy order here, buy order here, stop loss here. In case this is a first wave, you're gonna bounce in one of these things and ride the third wave. We just did the Fibonacci in the previous lesson, so I think you get the point. If you think that breaking this downtrend line is an important reversal, you study this one right there in the lower time frame, and you realize that there's a lot of bullish signal. You go ahead and place a trade, and a trade is a risk you take, and the risk is you exposing your money at those levels using Fibonacci, and you use your stop loss as a way to take a loss, a planned loss, if your analysis was wrong. See, that's it. So maybe in other indicators that we're gonna talk about, MACD or SI, you have a divergence here, sets of signal that tells you that, there's just way too much bullish signal. The market is probably reversing. Let's just go ahead and use Fibonacci to take this wave. I consider this wave as a first impulse. Now, do we have to get into the detail of counting wave? I know some traders do it. They work for them. That's fine. But for swing trading perspective, we want to catch a swing. That's all. And remember, in a bull market, swingers, we don't short. So we don't care about that. We don't care about that. We're not shorting. So we look for upswings and we ride. That's all. Moving stop loss, riding pullbacks or retracement. So in the second wave, this is the third wave. Sorry guys, the third wave, we know it's an impulsive wave, and you can use the same thing, your Fibonacci tool, to enter another swing. Take this swing for an example. Same principle, same situation, but because it's a third wave, usually we don't get deep retracement, usually not way too deep, and definitely not 100%. This is probably the second wave, is usually the wave that I use the 78 as stop loss, a little bit higher usually. So that will be it, using Fibonacci on the third wave, which is an impulsive wave. But this is where many people will fail. The wave 5, you should never use Fibonacci for wave 5, because the wave 5 is calling for a major correction of this entire structure, because this entire thing is a first wave. So you can use Fibonacci for 1, for 3, but never for a wave 5. Never for a wave 5. When you made it to the wave 5, you call it a wave 5. You need to pull up your Fibonacci level for the entire thing and pay attention to this level. For an example, 38, 50, golden pocket, 78, and definitely where you take the loss. This is extremely important. Now, that will be an example of Google 2005, and we know in 2008 we had it was not a tech bubble, but that's definitely a wave 1. And as you can see, that stuff, this is certainly a second wave. Now this shot, I took this shot very it was 2020, really before COVID-19 actually. So that's how old those PowerPoints are, guys. Before COVID-19, I'm pretty sure that we broke somewhere here. Might need to go ahead and do some update eventually of this kind of thing. Now, another important subject about Fibonacci is this: do you use week or not? Here's the thing: it's either you do week to week or body to body, but do not mix them. There's no such a thing of week to body or body to week. Just don't mix them. Okay. Now, a great tip, and this thing will make you money, and this is the money I give you just because you made it so far in the lesson. I'm just giving you money right now. A great tip is to use the 55.99 EMA crossover on a bull trend, 55 ENA cross under in the bear market. Like I said, you're welcome. You're gonna like it, and you use it as a swing. You swing over it. See if I can tell you. If I can give you that interesting explanation real quick. So you have 55.99 they cross. The wave that, man, that's ugly. You have a 55.99 cross, and the wave that goes over it, you can use your Fibonacci tool to take it. Let me go ahead some example. Drawing that stuff is terrible. Now this is a 55.99 crossover. We are on EOS 1 hour time frame. I usually do that in 1 hour time frame because remember, these are the time frame in which we take action, the 1 and the 4 hour time frame. So we take this 55.99 and we consider this entire thing as a wave to use Fibonacci to enter. So we do week to week, and then we try to get, like I said, I like to buy some traders buy those 28. I think I only take the risk of the 28 if it's the third wave, but the first one generally retrace deeper. So I'll take the 38, 50, 61, 78, and my stop loss is here. Now I'm gonna show you how to use to ladder properly so that you can go ahead and catch a swing. See, that's what we do. We catch swing. We swing traders. I don't want to get into the detail of this is A, B, C, little z, and little z. I don't have to get there. It's not important for me. I don't care about that stuff. Like, oh, this is 1, 3, and it's corrective wave, and we call that Z, X, Y, Z. That's not important. We keep things simple, and we catch swings. All right, that's all good. Another one. See that? That's a 1. See that? That's 1. Then you use your Fibonacci. See that? That's another 1. See that? That's another 1. You get stop out. No, you will have take this one right there, this swing right there, and you move up somewhere here. We're gonna study that. What do you say? That strategy very in detail, especially on part 4 of the class. But you get the point. I did some application of Elliott wave for you here. 1, 2, 3, 4, 5, and corrective wave, impulsive wave, and I'm pretty sure you see the correlation between Elliott wave. And the reason why you just have to know the basics really about Elliott wave, but nothing very complicated. So this is where I told you is extremely important. See that we did Fibonacci in the first, a second, but not this one, because we should be using Fibonacci over this entire thing. Most traders do not know that. This is insane. They're using Fibonacci one after the other. The third one should be about the entire development, the entire impulse in itself. This is the right way to do it. See what I mean? Now, you use Fib here, but you don't do it here. Okay? Nice and beautiful, ABC, as Elliott wave counters like it. So, now that you know how to place a Fibonacci, the question is, how do you know how to trade the level? See, you place the Fibonacci, you're gonna see thousands of people. After you see my video, you're gonna start catching mistakes and terrible error. You're gonna see who's beginners and who's not. You're gonna watch them posting videos on all social medias, and you watch their screen and you'll be like, this guy literally don't know what he's doing. Now remember all the principle related to statics and support resistance on part 1. 100% of those principles apply to all the level in Fibonacci. So just like every static support resistance, these level cannot be used as buy and sell signal without proper calculation or money management that we talk about. There's no such of thing of the golden pocket must react. The golden pocket react a lot. Every time I identify an opportunity to test it, I do, because the golden pocket react a lot. It's just the thing is that it doesn't have to. The market literally do whatever it wants. So I know that 90% of you Fibonacci traders will not be agree with that, but go ahead and we're gonna go ahead and see that. Now, any Fibonacci level can react brutally or not, and honestly, the reaction we get from different level on Fibonacci tells you more about the trend in itself, the sentiment, is it very strong or not? Is it a weak sentiment or strong sentiment? None of them are more powerful than others. Some of them are more popular, I'll give you that. The 50, the 50, the 50%, 61%, they're extremely popular. Most Fibonacci traders always trade them. But there's no such of thing that it's more important when it comes to Fibonacci. They can all react. Okay? Now, the reason why I, for an example, do not trade the 23%, it's for money management purposes only. But a 23% Fibonacci level can perfectly be a very good trade. And most of the time, I miss opportunity on them. It's okay. But for me, I need more retracement in the bull market or deep or higher bear rallies. And I need at least 38, 50, 61. But that's me. That's me. There's different way to balance that a little bit. But like I told you, how you trade those levels, it's all about money management. Not necessarily that one level is more important than other. Now, 100% Fibonacci retracement, let me tell you something. If you see that stuff, get out. Take the loss. Over time, you will be richer. Trust me. A 100% Fibonacci retracement is not something that happens a lot. But if you see it, don't go ahead and play the hope card. Take the loss, please. This is the biggest reversal sign in the market. You see that stuff in 4 hours, 1 hour, daily time frame, please take the loss, no matter what. Because this type of thing, they don't really happen, especially when you're trading big market cap assets. They don't happen often. You see that stuff, you take the loss. Okay? Now, let's go over some common belief. 22%, 28%, they are the weakest. That's not true. Any level can be strong in the Fibonacci level. All of them. Now, these levels are generally the most tested. I'll give you that in the movement. And as a result, they react more often and might get weaker over time. So, if you have a 23% level, 38% level, 50% level, after an impulse, we tend to bounce off of them. Now, if we are in a bull market, the supply at that level we will run out of supply at that level. And that's the reason why most people think that it is weaker. It's not weaker because it's 23. It is weaker because that stuff is very tested, and if there is a lot of supply here, it makes sense. It makes sense that people are buying it, and then you run out of supplies, and then we keep going up, or eventually go deeper, get a little bit more supply. So the supply get a little bit, you get way more supply, and then we have to drop the price a little bit so the bulls can step in, maybe a little bit deeper, and then boom, we take over again. But this is not because 22 is weaker. Okay, now these level reaction are in favor of the major trend continuation. And one thing you need to know about the higher level and lower level is that if you have a trend that do not retrace that much, that trend is actually stronger. Most people are looking for 38, 50, 61%, but if the price can go all the way down before takeover, this is a good way for you to enter from a money management perspective. But if we retrace on 23% only and keep going up, the trend is actually unbelievably strong. People are buying at a very high price. So the other thing is that they'll tell you, you will hear that 50 and 61.8% to 65%, the golden bucket, and lower are stronger. That's actually false. That's not true. All level can behave the same way. It's all about what type of demand is there in a bull market, and what type of supply is there in a bear market. Contrary to the upper level, they are not often tested, so they maintain their energy, and that's the reason why they give you the illusion of being stronger. But most of the time, they are tested once or twice. The 23 can be tested like thousands of times. Every time the price go through that zone, we have people trading. So this zone is heavily tested. Makes sense. In a bull market, if there's a lot of demand somewhere here and a lot of supply is dumped on it, it makes sense. You run out of demand here. We have to go a little bit lower so we can get the bear to be more interested, and that's why we get a takeover. But what happened is that so often, since most people will place a bunch of order at that level, there is a huge level of supply here, so that doesn't make it stronger, because this level has to be stronger. It's just that this level most of the time in the bull market, in the way up, and also in the bear market, those level, they tend to be more less tested, and they keep their energy. So, but they are very close to 100%. That makes them scary actually. So if we go through them without hesitation and keep going up, I usually use the 68% as a stop loss at an early. I mean, if I'm close to a reversal, I use the 68%. If I'm kind of far from a reversal, I'll say no. Sorry about that. If I am close to a reversal, I use the 100% as a stop loss. And if I am far from the reversal, I tend to use the 68% more as a stop loss. Now, the other thing, this is the Fibonacci, and this is interesting presentation here. They can all react. Now, this is 38%. We go up here, we drop on this thing, we go up. You bounce over the 22%. The trend is actually very strong. People are buying at that level. This price is clearly more expensive. See, the deeper we go, the cheaper that stuff is. But if we have to go that low to get a bounce, that means the supply is very high, and we have to go all the way down to get the bull to be interested a little bit, so that the market can take over. Now, the moment there's enough supply to retrace the wave 100% on itself, that means that the supply is going up. Supply is going up way too much. The price go way too low, and even there, bulls are not buying. Then why would you buy that stuff? Why would you stay in a long position here if bulls are not buying? Remember, if you buy something at $1, that stuff is in your hand. Someone else need to step in and buy at $1.01 to increase the price. If nobody is doing it, and you get a retracement, a 100% retracement, why would you hold that thing? Why would you stay in this trade? You take your stop loss and move on. That's just the way it is. So, how you use the level is everything. 90% of traders know how to place them, and I'll tell you what, less than that, like, I'll take 99, honestly. Only 1% of traders know actually how to use them. You can place them, you can know what they mean, and you're gonna screw up your portfolio anyway. You know what? Because the best way to use Fibonacci is all about money management. So the best way to use Fibonacci retracement is to place order using Fibonacci sequences, but in a certain way. Using an example is the only way to integrate. So let's just go ahead and forward this. So case, we're in a bull trend, and let's say that you want to trade EOS, and $10 is 23%. Your level, your account is like $100,000, right? So you have like 20%, 30%, 50%, 61, 17, like this. Okay. Now you buy 10 EOS here, and this is where the magic happens. The way you place this order must reflect the Fibonacci sequences. And I'll tell you this, guys, most people don't know that. When you're using Fibonacci to enter a trade, the size of your order must be placed in accordance to the Fibonacci sequences itself. With that being said, these are your first order. This is your first order. This is your second order. The addition of those two orders give you the size of the third. I don't know if you get that. All right. Now, this is where it gets a little bit more tricky. If you are trading retracement, 38 and 23 have been triggered. At that moment, you have 20 EOS. Very interesting. If you fail that stuff, you will screw up every time trading Fibonacci. At that point, you have 20 EOS. All right. Now, if those two first orders have been triggered, and at that point you have a 20 EOS, and your price is somewhere here, okay, somewhere here. You have 20 EOS somewhere here. Now, instead of going up, the market, let's say that keep going down a little bit, and then your 30 is triggered. The size of the third order, okay, should be the exact same thing for this. So you're gonna have 20 EOS here. You see, that's the thing. Those two orders, when they get together, they give you 20. All right, that was a 20. So in order to respect that sequences, this order will create a third average price. That third average price should be the addition of the last two positions, which mean when those two get together, they create 20 EOS. That's one position. The third should be the result of the addition of the previous order plus the next one, which is another Fibonacci sequences. That's another 20 EOS. If you don't do the math properly, you will always fail trading Fibonacci. And most people don't get that. I mean, just go ahead and place a couple of orders and you think that's it. That's not how it works, guys. So at that point, when your third order gets triggered, you have 40 EOS, and your price will drop. Your average price will drop somewhere here, and here you have 40 EOS. So if the market decide to go like 61%, then you're gonna have a fourth order. Okay, that fourth order, okay, gonna be 40 EOS, and the reason why it's gonna be 40 EOS is because it's the sum, the addition of the two previous order, the 20 and the 20 will give you like 40 EOS. Then you add a 40 EOS on it. That's another fee. That gives you 80 EOS right there. So I know it's a little bit tricky, but a simple way to do it is just the first two order are the same, and then you keep times 2. Give you 40 times 2, give you 60. But the reason why you do that is because you need your orders size to respect the Fibonacci sequences, and when all these orders get triggered, they manipulate your average entry price. Your average entry price. And this average entry price will kind of make it easier for you to be in a profitable situation. See what I mean? In a profitable situation. Now, the 100% is simple. At that point, if we get deeper, you already have 100 EOS. If we go on 100%, never violate this would take the loss. Over time, you will make way more money. You know, from my personal experience, if you're using this properly in 1 hour time frame, sometimes you're just gonna have to take one trade for the entire month. So if you lose one trade, it's fine. You take a trade in the beginning of the month and you close it by the end of the month. If you lose 20% on this trade, and the next one gives you 250%. Who cares about that small loss? It's just the way it is. It's just business, honestly. So your order should not go over your predefined position. Don't just add order to add order, and you should decide your position based on how you set up your money management in a way that your portfolio can take it. If you margin trade, your margin situation can take it, and overall your emotional situation can take it. Can you actually take that psychologically? Now the interesting thing about trading Fibonacci is that And just like the risk ratio, it gives you the opportunity to accept the loss if ever it happened, before it happened, if it has to happen. And I think this is beautiful. You make peace with the loss if it has to happen. See what I mean? And then you wait. Most of the time, a stop loss is what take me out of the market, because I like to ride things. I'm just gonna stay here and keep on my trade, stay in the trade, and we keep going up, and the next thing you know, I close something 150, 200, 300% gain. It's just the way it is now. I will put more example in the book itself, because I think I cannot keep go ahead and explain all that on a video. An example that you can read and you can literally print out or make copies and do some working on them. So that's the reason why we'll do more integration of the techniques about that in part 3 of the class. So that's why I'm kind of speed that up so we can move very fast in the third part. Okay, that's it for Fibonacci retracement. I will leave Fibonacci extension for the third part, because Fibonacci extension is essentially used for target price, essentially used for how to exit. And just like I show you how to place and size your order to enter, there's also a way to size your order when you're exiting and maximize your profit unbelievably. So this is interesting. I can literally give you a trailer, if you can say it like that. It's by 10 asset here, 20 asset here, 30 asset here. And when you are exiting, you're exiting the same way. Like you sell 30 here, 20 here, 10 here. The kind of profit you make on this is insane. So when you do the math, that stuff can increase your portfolio exponentially. This is impressive. Like I said, you're gonna like it. Part 3, bear with me and stick on that. Now, as a disclaimer, this channel does not intend to replace any trading and coaching programs. It's a deep introduction of the world of trading, crypto trading, technical analysis. The series of this channel must not be considered as financial advices or content. Our content are only here to educate, inform, and entertain. Trading can be very risky. Only risk money you can afford to lose. Alright guys, if you did like this video, remember that you can find me on different Discord server. See them on the description below. And if you did like the content, share, subscribe, the whole thing, so the channel can thrive. Okay, have a good one and take care. Bye.